In this lecture, we will be discussing various types of investment vehicles and their role in a portfolio. In every investment, the investor plays one of two roles. The investor can be a lender. If the investor is a lender, then they are providing money to other entities which use the money and return interest to the investor. Bank accounts and bonds are examples of investments where the investor is a lender. The investor can also be an owner. This can be done by either owning your own business or by becoming a partial owner in another company. Fractions of ownership of a company are called stocks, and the purchase of stocks is the primary form of ownership investment. Investing as a lender is typically less risky than investing as an owner. So what kinds of investments are there? We'll look at each in turn, starting at the bottom of the investment pyramid. Cash and cash equivalent accounts are often called transaction accounts. These are very highly liquid, very low return accounts that are generally held by banks and are FDIC insured. FDIC stands for the Federal Deposit Insurance Corporation. This is a government program that guarantees that the funds held by an FDIC insured bank will always be available to the depositor, even if the bank goes out of business. Checking and savings accounts are the most common types of transaction accounts. The next asset category is called intermediate accounts. These accounts are similar to transaction accounts, but they are slightly less liquid. The most common intermediate accounts are certificates of deposits, called CDs, and money market funds. CDs are notes which one can purchase from a bank. Each CD has a specific term that is generally between 1 month and 10 years. During this term, the investor is not allowed to withdraw the money they put into the CD, and the bank pays the investor the agreed upon interest rate. Money market funds are similar to checking accounts, but with additional restrictions on their withdrawal terms. This lack of ability to withdraw CD funds at any time and the restrictions on market fund withdrawals reduce their liquidity. This reduction in liquidity allows these investments to provide slightly higher returns than transaction accounts. The next category of assets is called investment vehicles. These are the types of investments that are most commonly used to invest. Bonds are a form of investing where the investor is a lender. When an investor purchases a bond, they are giving a loan to the corporation or government entity that issued the bond, and they receive interest payments in return for their loan. Government bonds are unique among investment vehicles in that they are inherently tax-free investments. However, because they are less risky than corporate bonds, they typically pay a lower interest rate than corporate bonds. As we have mentioned before, stocks are simply a fractional ownership of a company. If you own a share of Disney stock, for example, then you own a tiny part of the Disney company. This entitles you to a portion of its profits, but it also makes you liable for a portion of its debt. A mutual fund is simply a collection of investments. Mutual funds can contain all stocks, all bonds, or a mixture of the two. The exact combination of investments held by the mutual fund is determined by the mutual fund manager. Mutual funds charge fees for their management, but are a great way to diversify your portfolio with relatively little work on your part. Real estate can be a great investment vehicle, but it also has substantial risks. Approach real estate investment with caution and care, and do your homework on any real estate investment before you buy. The last category of investments is called speculative investments. These investments include options, futures, collectibles, and some types of real estate investment. These investments are called speculative because they are extremely high risk, but the potential rewards are also great. These types of investments are not for everyone. You must be very risk tolerant to handle owning these types of investments. They do not necessarily have to be included in a portfolio in order for a portfolio to have a healthy degree of diversification. To be properly diversified, you must buy investments that move in different directions. This makes it so that when some of your investments go down, other investments go up. Since the overall trend of the market has been consistently positive, in the long run, a diversified portfolio will have more winning investments than losers, and its value will go up. It is important to keep in mind that diversification does not increase your overall return. There is only one reason to diversify, and that is to reduce the riskiness of your investments. A properly diversified portfolio can provide the same return as an undiversified portfolio, but does so with less risk. Mutual funds, exchange-traded funds, target date funds, and real estate investment trusts are effective ways to diversify with relatively little effort on the part of the investor. A mutual fund has a fund manager that is paid to diversify the fund for investors. Because they hold a variety of other investments, a mutual fund provides some diversification automatically. An exchange-traded fund is a fund that is not actively managed. Rather, it is a fund that simply tries to mimic the movements of the overall market with as little cost as possible. ETFs have good tax efficiencies, similar returns to mutual funds, and often have much lower fees than mutual funds. Real estate investment trusts are like mutual funds, except instead of purchasing stocks and bonds, they purchase real estate. They are a quick and efficient way to invest in the real estate market without having to buy physical property. Target date funds are also like mutual funds, except that they buy other funds. When you purchase a target date fund, you select a date at which you would like to retire. The fund is designed to automatically change its collection of investments as you grow closer to the target date to help improve your chances of being ready to retire at the date specified. All of these types of investments can be purchased through mutual fund companies such as Fidelity, T. Rowe Price, and Vanguard. As a rule of thumb, when selecting between otherwise similar investment funds, select the one with the lowest costs.